Hello class, I welcome you all to this session. This session we are going to discuss the 60-second problem. Following was the balance sheet of A and B who were sharing profits in the ratio of 2:1 as at 31st March 2017. Liabilities, capital account A and B, sundry creditors, assets, building, plant and machinery, stock, sundry debtors. Then you have cash in hand. They agree to admit C into partnership on the following terms. C was to bring in 7,500 as his capital and 3,000 as goodwill for 1/4 share in the firm. The value of the stock and plant and machinery were to be reduced by 5%. A provision for doubtful debts was to be created in respect of sundry debtors. Building account was to be appreciated by 10%. Pass necessary journal entries to give effect to the arrangement. Prepare profit and loss adjustment account, that is revaluation account, capital account and balance sheet of the new firm. So first is we have to know what is the sacrificing ratio of A and B. What is the sacrificing ratio A and B? It is 2:1 because the old ratio given is 2:1. Then you have distribution of premium for goodwill distributed in sacrificing ratio. So A's goodwill, total goodwill brought in by C is 3,000, 2 divided by 3 which is 2,000, and B's goodwill, that is 3,000 into 1 divided by 3, that is 1,000. Then distribution of profits from profit and loss adjustment account in old ratio. So we will first find out what is the profit and loss adjustment, whether it is a loss or a gain, and then we will move ahead and work out this one. So first, stock, we had stock as well as plant and machinery. So stock as well as plant and machinery are reduced by 5%. So to stock, to plant and machinery, 5% reduced means it is 500, and for machinery it is 875. Okay, then a provision for doubtful debts was to be created in respect of sundry debtors. So to provision for doubtful debts. So to provision for doubtful debts, it is 375. Then by building, it is appreciated. Building appreciated by 10%. By building appreciated 10%. So to profit transferred to A's capital account, B's capital account. So 500 and 250. Okay, so if you are doing this, so this is the value. The total of the difference between this and this comes to 750. We have to segregate this in the old ratio, that is 2:1, which comes to 500 and 250. Okay, so I hope that this part is clear. Then moving ahead, we need to prepare partner's capital account. So by balance brought down 15,000 and 10,000. By cash account brought in by new partner 7,500. By premium for goodwill account 2,000 and 1,000. By profit and loss adjustment account, that is profit 500 and 250. To balance carried down, you have 17,500 and 11,250, 7,500. So the total of this. Okay, next we are going to prepare the balance sheet as on 31st March 2018 after C's admission. So you have first capital account A, B and C have 17,500, 11,250 and 7,500. Total of this comes to 36,250. Then you have sundry creditors 32,950. Then you have building value appreciated to the extent of 2,000, so 2,500. So 10% it's got appreciated, so 27,500. Plant and machinery, it got depreciated, so 8,875. So 16,625. 16,625. Then stock 10,000 minus 500, 9,500. Less you have provision, sundry debtors, so sundry debtors is 4,850 minus provision for doubtful debts. You have the provision for doubtful debts as 375. So you have 4,475. Then cash in hand 600 plus 10,500, so 11,100. The total will be 69,200. Okay, so this is the end of the problem. So we'll be discussing one illustration problem too. With this chapter will be over. Okay, and please mind it, you don't have adjustment of capital account, and so I'll just tell you which part is deleted in this particular chapter so that you can be prepared. So you don't have this chapter, that is adjustment of capital. This part is deleted portions. Okay, so you don't have these adjustments regarding capital adjustments, all these things are not there. So admission of partner during the year, you can just go through it, that's it. So last thing we will be discussing will be this particular question. A and B are partners sharing profits and losses equally. Their balance sheet as at 31st March 2017 is given below. Liabilities, assets, capital AB, current account AB. See, you have capital as well as current account. Creditors, bills payable, land and building, plant and machinery, furniture and fittings, stock, debtors, provision for doubtful debts, bills receivable and bank. C is admitted as a partner for 1/4 share on 1st April 2017 under the following terms. C is to introduce 2,50,000 as capital. Goodwill is agreed to be nil. It is found that the creditors included a sum of 15,000 which was not to be paid. Liability for compensation to workmen amounting to 20,000. Provision for doubtful debts is to be created at 10% on debtors. Then it was decided to henceforth follow fluctuating capital method. Okay, bills accepted worth 40,000 issued by a creditor were not recorded in the books. Then A provides 1 lakh loan to the business carrying interest at 12% per annum. Prepare revaluation account, partners capital account, partners current account and balance sheet of the new firm. So first we have to find out what will be the entry for this. You need to understand this. Bills accepted of 40,000 issued by the creditors do not affect the revaluation account because this transaction increases one liability, bills payable, and decreases another liability, creditors. So accounting entry will be creditors to bills payable, so 40,000 and 40,000. So this will not affect the revaluation account. So under the revaluation account we have these items as liability for compensation of workmen, 20,000, and provision for doubtful debts 10% on the debtors. So it is 10% on 1,50,000, which is 10,000. So minus 10,000. See, 1,50,000 10% is 15,000 minus 10,000 already provided. So you just have to write 5,000, and then by creditors 15,000. So you can find your creditors including a sum of 15,000. So we are writing it here. Then by loss transfer to A's capital account and B's capital account. So by which you have finished the revaluation account. And after that you have the partners current account. So by balance brought down 80,000 and 60,000, you bring the balance from the capital, that is the current account in the balance sheet. So after that you have to write down the two revaluation account in the current account, because capital account it's like fixed, right? So you cannot have these changes recorded in the capital account. So you need to write the revaluation account under the current account. So 5,000 and 5,000 is over. So to capital account is 75,000 and 55,000. Then partners capital account, you have by balance brought down 3 lakhs and 2 lakhs. Then by current account you are just bringing it down, and then by bank account 2,50,000, which is being brought by the new partner. So the balance carried down seems to be this. And after that you have the balance sheet of the new firm, A, B, C and capital account. So you are henceforth they are just going to maintain the fluctuating capital method. So you just have to include this as capital account. There will not be any current account. Previously they were maintaining fixed capital method, but now they are changed to the fluctuating capital method. So we are just following the instructions. Okay, so you can see in here. After that you have the liability for workmen compensation 20,000, A's loan 1 lakh, creditors 2,60,000 minus 15,000 minus 40,000. Then bills payable 1 lakh plus 40,000. Then you have land and building, plant and machinery, furniture and fitting, stock, debtors less provision for doubtful debts and bills receivable, bank. So all these transactions you will be balancing your balance sheet. So that's it. So by which we have completed chapter admission of a partner. So in the next class we will be starting a new chapter, that is retirement of partners. So we'll be starting with retirement or death of the partner. Thank you class.